Welcome to today's presentation, where we will introduce you to the CSRS retirement process. Please be advised that this presentation will not cover retirement provisions for the members of the alternate retirement program or the teacher's retirement system. Additionally, please note that this presentation is for employees that work for an in-scope agency covered by the DAS pod. If you work for an out-of-scope agency, the information we discuss today will still apply to you. However, instead of reporting to the DAS pod, you will work directly with your Human Resources Department to initiate the retirement process. The first thing you need to know about this process is that you can learn a lot about it from our online resources. Our workshops, benefit estimators, and videos of our past retirement counseling sessions can provide you with more information than we have ever provided in the past. All the information you need to make an informed decision about your retirement is available to you through our website at osc.ct.gov/retirement. Additionally, most of you can get an estimate of what your monthly retirement income will be by using an online self-service estimator. We've made this tool available in Core CT to the majority of employees who are currently eligible to retire. To access your estimator, navigate to your Core CT homepage and click on the box marked Pension. Next, click on the box labeled Pension Estimate. The estimator will allow you to see what your retirement income will be based on different dates of retirement. In other words, you can compare the effect of choosing different retirement dates, which is something we were unable to provide in our past in-person counseling sessions. Please remember that the estimator will provide you with an estimate only. While it is our goal to have the estimator be close to what your final benefit will be, your actual pension will still be calculated by our retirement auditors after you retire when we conduct a comprehensive audit of your account. There are a few things I want to cover before I move into some finer details about your pension. First, for the purpose of this presentation, we are assuming that you have already made the decision to retire, but need to know how to start that process. Here is what we suggest. You start the retirement process by notifying the DAS Benefits and Leaves pod that you are planning to retire. Remember that your retirement date must be on the first day of a month. Understand that processing your retirement application takes time, and errors in your application paperwork can slow things down. We recommend contacting the DAS pod 60 to 90 days out from your intended date of retirement to get the process started. If you wait until the last minute, there is a chance that your retirement benefits could be delayed. There are also documents that you must provide, and we suggest you start getting them now. Every retiree must provide the pod with his or her legal birth certificate. If you're married, you will also have to provide a government-issued marriage certificate. If you want your pension payments to be paid to a survivor after you die, which is a topic we will cover later today, then you must also provide the legal birth certificate of the person or persons you plan to designate to receive that benefit. Please note that all of these documents must be government issued. For example, a marriage certificate issued by a church is not acceptable. The DAS pod will provide you with the fillable retirement forms. You will complete those forms and submit them to the pod, who will then forward them to the Retirement Services Division. The best way to make your retirement go smoothly is to make sure those forms are filled out correctly before the pod sends them to us. The best way to make that happen is to complete your forms in person at the DAS pod. You will receive a link to book one of these sessions when you receive your retirement application, or CO 898, from your pod representative. Here are two common problems that can be prevented by completing your forms with the pod. First, some members have had a name change, for example, due to marriage or other legal means. If the current name does not match the first, last, and middle initial on the birth certificate, you or your annuitant will need to complete an AKA name affidavit and can do so in person with the DAS pod. In other cases, some members can't produce a birth certificate, for example, because they were born in another country. Those members also need to complete an affidavit. Your pod representative will let you know what other government-issued forms you will need to bring with you so you can complete all your forms on the day you meet with the DAS pod. These rules also apply to your survivor option. If you are taking a survivor option for someone who we call your contingent annuitant, they too may need one of these affidavits if their current name does not match the one on their birth certificate, or they cannot produce a government-issued certificate itself. When you attend your session at the DAS pod to complete your forms, you should also bring your spouse along, in case there are forms that he or she will need to sign or have notarized. You should also bring any contingent annuitant who is not your spouse for that same reason. When your retirement paperwork is complete, the DAS pod will send it to the Retirement Services Division, who will begin the comprehensive audit that will determine the amount of your retirement income. You'll begin getting payments on the last working day of the month in which you retire. For example, if you retire on November 1st, your first pension payment will be made on November 30th. Your first retirement payment will be an estimated amount. The auditors will put you on the payroll in an amount close to what they believe your benefit should be. Afterwards, they will complete a final audit to ensure the amount you are being paid is accurate. During this final audit, any payouts you received at termination that are pensionable for average salary will be taken into account, and your pension will be adjusted accordingly. Once the audit is complete, you'll start receiving the final amount, and we will adjust retroactively for the difference between the estimate and what you should have been paid. At that time, you will get a letter that advises you how your benefit was calculated. And now, I will briefly cover some details of your state pension. In the following slides, we will be covering what you can expect as a new CSRS retiree, including the kind of retirement benefits that CSRS offers, as well as when you can start receiving those benefits. Next, we'll cover how to estimate what your benefit will be. Then, we will also explain how you can protect your family by arranging to have your pension continue after your death. We will then touch on how retiree health insurance works. Afterwards, we will briefly discuss the optional defined contribution plans and other supplemental benefits available to retirees. And lastly, we will close out our presentation with a Q&A session to answer any questions you may have. Let's start with the basic facts about retirement. When you retire as a state employee, you are guaranteed certain benefits. First, a retirement income that is paid monthly for the rest of your life. Second, as long as you meet certain eligibility requirements, you will qualify for retiree health insurance. You will pay a portion of the cost of that insurance out of your monthly income. When you become eligible for Medicare, you must enroll in that program. You will have to pay premiums to the federal government, but the state will currently reimburse you for those premiums. Additionally, if you participate in a defined contribution plan, you may distribute funds from that plan as well. So, what do you have to do to get these retirement benefits? First, you must satisfy the age and service requirements for your respective tier. In other words, you must have completed a minimum number of years of state employment, and you must have reached a minimum age. Second, you can't begin to receive retirement benefits unless you have terminated your state employment. This part is up to you. The age and service requirements are the same for everyone in your tier, but you get to decide when you want to stop working. Today's presentation will cover 3 types of retirement: normal, early, and hazardous duty. Your retirement is called a normal retirement if you have completed the required amount of state service and have reached what we call normal retirement age. Normal retirement age is different across the different tiers of CSRS. Your retirement is called an early retirement if you have completed the required amount of state service and you've reached the minimum retirement age for your tier, but you haven't yet reached your normal retirement age. If you choose an early retirement, your monthly benefit payment will be smaller than it would be under a normal retirement. The amount of the reduction depends on how far you are from normal retirement age when you retire. The further you are from normal retirement age, the smaller your pension will be. It is important to understand that this is a permanent reduction. If you select an early retirement, this reduction will not be changed when you reach normal retirement age. Any increase to your benefit after retirement will be limited to annual cost of living increases. Additionally, if you choose an early retirement, you might also pay more for retiree health insurance. Whether you do so and how much you do depends on your age at the time you retire and how much state service you've completed. If you retire very early with fewer than 20 years of service, you might have to pay as much as 25% of the total healthcare premium. As we'll explain later though, the increased healthcare cost is not permanent. You'll stop paying it when you reach your normal retirement age. Hazardous duty retirement is a separate category of retirement. Those of you who have completed 20 years of service in a hazardous duty position may retire under a hazardous duty retirement at any age. The amount of your monthly retirement income will depend on 3 factors, unless you retire under hazardous duty, which has no minimum age requirement. Those 3 factors are service credit, average salary, and your age at retirement. The first factor that we will discuss today is service credit. When we calculate your service credit, we include the following: all paid state employment in a pension-eligible position that was not followed by a permanent break in service, and where mandatory retirement contributions were paid if applicable to your tier in CSRS. We also include certain periods of qualifying workers' compensation, properly documented voluntary leave taken after June 9, 1994, furlough days, and accrued vacation paid at termination. When you leave state service, you will get paid for any remaining unused vacation time. That time will be added to your service credit. However, it may not be used to make you eligible for hazardous duty retirement. Lastly, if you've completed a purchase for additional credit, such as credit for prior military service, that too will count towards making you eligible for a normal or early retirement. One last point, for those of you who are retiring under a hazardous duty retirement, any non-hazardous duty service you performed will not count towards your 20 years of hazardous duty service. That is, it will not count towards your eligibility to retire. But that time will not get lost. We will still use that service to determine how much you will be paid in retirement. The second factor that determines your monthly retirement income is your final average salary. There are a number of special rules that go into calculating the average salary we use to determine your retirement income. Your average salary will be the average of the income you receive during 3 selected 12-month periods if you are in Tiers 2 or 2A, or 5 12-month periods if you are in Tiers 3 or 4. We select the 12-month periods in which you receive the highest amount of salary. Please note that each 12-month period need not be consecutive years, nor do they need to be calendar years. We might use one 12-month period that runs from June through the following May, and another that runs from November through the following October. And they need not be your last 3 or 5 years, unless those are the years in which you were paid the most. There are also certain rules that might limit the amount we use as your income for one of these 12-month periods. While we will not be covering the details of these rules in this presentation, we address them specifically in other video presentations available on our website, again at osc.ct.gov/retirement. Lastly, please note that your accrued vacation days may make a small adjustment to your average salary, but we do not use it as a lump sum in our calculations. And the last factor we will cover today that affects your benefit is your age at retirement. Unless you are retiring under a hazardous duty retirement, there are minimum ages that must be met before you may collect a benefit. The specific age and service requirements for normal and early retirement are different for each tier. However, to summarize this slide, for most of you, if you have 10 years of service, you can retire under an early retirement at age 55. And if you have 25 years of service, you can retire under a normal retirement at age 63. Otherwise, normal retirement age is 65. Additionally, if you previously elected to grandfather your right to retire under the prior rules for normal retirement age, you may take a normal retirement at age 60 with 25 years of service, or at age 62 if you have less than 25 years of service. Lastly, please note that if you are in Tiers 1, 3, or 4, these rules are different. Please refer to your tier's summary plan description for further details regarding these requirements. And now that we've covered the basics of your pension, I will now discuss how you can protect your family after retirement by electing a survivor option. Once you retire, you will receive benefits for the rest of your life. Additionally, you may choose to have benefits paid after your death to another person whom you designate. How much that person receives and for how long they will receive that benefit depends on which survivor option you select at retirement. Additionally, it is important to note that whether the person receives health insurance after your death will also depend on this choice. If you choose to provide for survivor benefits, your benefits will be reduced. We recommend you use the Core CT benefit estimator to see what the reduction will be for various options. Before we cover some of the finer details of each option, you should note that there are 2 important features that all survivor options do have in common. First, you pay for the benefit to your survivors by accepting a smaller benefit for yourself during retirement. How much smaller depends on the option you select. Second, this is a one-time, irrevocable choice. You select an option at the time you retire. Once you have made that selection, it can never be changed. You cannot change it if your designated survivor dies before you do, and you cannot change it if you designate your spouse and end up getting divorced in the future. There are 4 basic options, option D, A, B, and C. Option D is called the Straight Life Annuity. This option provides you with the highest monthly benefit during your lifetime. However, all payments will stop at your death, including health insurance. Option A is the 50% spouse benefit. This option first provides a reduced monthly benefit to you for life. then 50% of that monetary benefit will continue after your death for the lifetime of your surviving spouse. If you were still married at the time of your death and qualified for retiree health insurance, then your surviving spouse will continue to be eligible for retiree health care. Up next, option B is called the 50% or 100% survivor benefit. This option also provides a reduced monthly benefit to you for your lifetime. After your death, payments will continue to the person you choose for the rest of that person's lifetime. We call that person the annuitant. The annuitant can be your spouse, or it can be any other person you designate. Your annuitant can receive either 50% or 100% of the benefit that you received based on your choice at the time you retire. If you choose the 100% option, while this does provide a higher benefit to your survivor at the time of your death, your monetary benefit throughout the course of your own lifetime would be reduced. Your annuitant, provided they are an eligible dependent, will also be eligible for retiree health insurance, with premiums deducted from the pension payments for as long as they maintain eligibility status. Please note that if you choose a 100% survivor option for someone who is not your spouse and is more than 10 years younger than you, federal law may put an additional limit on the amount your annuitant receives after your death. Up last is option C, also known as the 10-year or 20-year period certain. This option provides reduced monthly payments to you for your lifetime no matter how long you live. If you die within 10 years or 20 years of your retirement, whichever you choose, then the person or persons you designate will continue to receive the equivalent of 100% of your monthly payments until the end of that 10 or 20-year period. In other words, if you die 15 years after retiring, and if you selected the 20-year option, your designees will receive a pension for another 5 years. The annuitant may also be eligible for retiree health insurance provided they were an eligible dependent, but only until that 5-year period ends. If you are still alive after the 10 or 20-year period, you will continue to get paid for the rest of your life. However, after your death, no one else will receive benefits. Additionally, this is the only option where you may elect more than one annuitant. They would receive equal shares if you passed away before the period expired. Lastly, option C also creates an exception to the rule that your choice of option is irrevocable. If your contingent annuitant dies before the end of the 10 or 20-year period you selected, then in that one case, you may name a new contingent annuitant. If you are married on the day you retire, and if on that date you will have been married to your current spouse for at least 1 year, then there are restrictions on your choice of survivor options. You are free to select options A or B with your spouse as annuitant in option B. Those are the options that provide a lifetime benefit to your spouse. However, be advised that if you do not provide a lifetime benefit for your spouse, you and said spouse must complete a notarized spousal waiver, providing written consent that your spouse understands what the effect of your election will be, and that they will not continue to receive benefits for their lifetime after your death. And now, we will move in to discuss retiree health insurance and supplemental benefits.
When you retire, you and your family will likely be eligible to receive retiree health insurance. Retiree health insurance operates in very much the same way as your current active employee health benefits. Your active coverage will continue through the end of the month in which you retire, and your retiree coverage will begin on the first day of the month after you retire. For example, if you retire on July 1st, your active coverage will continue until July 31st, and your retiree coverage will begin on August 1st. When you fill out your retirement application package, you will be able to choose which medical and dental plans you want during retirement, and you will name the dependents you would like to enroll on your plan. If you like, you may select the same exact plans and coverage you currently have as an active employee. This is not a one-time election. Just as you do as an active employee, you will have an open enrollment period once per year that will allow you to switch plans and add or drop dependents. You may also make changes to your coverage during the year should you experience a qualifying event like a marriage or divorce. One item that differs from your active employee coverage is our coordination with Medicare. If you or a dependent are eligible for Medicare, you will be enrolled in our Medicare Advantage plan. More to come on that in a bit. Additionally, if you complete an address change form with OSC indicating you are permanently moving out of state, you will automatically be enrolled in the out-of-area plan, allowing you to access providers in and out of network. Monthly deductions for your health insurance will be taken directly from your pension check, just as they are as an active employee. The cost for health and dental insurance in retirement varies based on several factors, including what plan you select, how many dependents you choose to cover, and your retirement type. For the most up-to-date information, please go to the Healthcare Options Planner on carecompass.ct.gov. Early retirees will typically pay more for coverage, up to a maximum of 25% of their pension. If you are considering early retirement, you will need to keep in mind you will likely pay more for your health coverage until you reach your normal retirement age. For those eligible for Medicare, there is no monthly deduction cost for the Medicare Advantage plan. When you or your enrolled dependents turn age 65 or sooner, if you are eligible for Social Security disability, you must enroll in Medicare Parts A and B. You will need to supply the retiree health unit with a copy of your red, white, and blue Medicare ID card, noting your ID number and effective date of enrollment, and you will then be transitioned out of your current health insurance plan and into our Medicare Advantage plan, which is currently provided by Aetna. This is a custom medical and prescription plan designed to provide you with the same copay and benefit structure you have under our non-Medicare medical and prescription benefit plans. You will be able to see any provider who has not opted out of Medicare, so long as they are willing to bill on your behalf, regardless of their network status. If an enrolled member of your family is not eligible for Medicare, they will remain with your current Anthem Medical and Caremark prescription plans. This is what we call a split contract. Those eligible for Medicare will transition to the Medicare Advantage plan, while those not eligible for Medicare will continue their current non-Medicare health benefits. It is important to note, Medicare will charge a monthly premium for Part B. They will either bill you quarterly or deduct the premium from your Social Security check. For those deemed high earners by Medicare, they will also charge an additional income-related monthly adjustment for Parts B and D. You must pay all required premiums. We will reimburse the standard cost of Medicare Part B and half of the income-related additional cost in your pension check. You simply need to provide us with a copy of your annual premium notice to establish the reimbursement. The coordination of our plan with Medicare may be confusing, we understand that. You don't need to remember all of this. The Retiree Health Insurance Unit will send you a letter about 3 months before your 65th birthday reminding you of the details.
So far, we've discussed the pension benefit you will receive from your defined benefit plan. Active state employees are also eligible to participate in the State of Connecticut voluntary defined contribution plans. All state employees may contribute to the 457 plan. Employees of certain educational institutions may also contribute to the 403B plan. Please note, members of CERS Tier 4 are required to participate in the mandatory Tier 4 defined contribution plan, which is separate from the voluntary 457 and 403B plans. The 457 and 403B plans provide the option to invest a portion of your active employment earnings on a pre-tax basis. The pre-tax money you invest and any earnings gained will not be taxed until you withdraw it during your retirement, when your tax rate is likely to be lower than it is now. You also have the option to contribute on an after-tax or Roth basis. Please visit the state's dedicated website, www.ctdcp.com, to enroll, log into your account, view webinars, and access plan resources. Empower also has dedicated retirement counselors available for one-on-one virtual meetings to discuss your defined contribution plan. You may schedule a meeting with an Empower counselor using the posted link, or by visiting www.ctdcp.com and clicking on Schedule a Meeting. You may contact Empower's call center by calling 844-505-7283. As you approach retirement, be sure to review the defined contribution plan options available to you. Some retirees choose to contribute all or a portion of their final vacation and sick payout to their 457 and/or 403B account. We encourage interested employees to confirm their final payout date an estimated payout amount with their agency about 1 to 2 months prior to retirement. Once you confirm this information, please reach out to Empower to complete the required form. After all mandatory deductions and taxes are withheld, you are eligible to contribute up to 100% of your remaining available earnings, up to your annual contribution limit. You choose what amount you would like to contribute. There are also several catch-up options available, which allow you to contribute more in your final years of employment. Eligible employees may participate in the 457 Special Catch-up option. The Special Catch-up allows approved employees to contribute up to twice the normal annual limit to their 457 account for 3 years prior to retirement. Interested employees must apply for approval and may do so from 4 years to 2 months before their retirement date. But the sooner you apply, the greater opportunity you have to take advantage of this catch-up option. Applications are available through Empower. Depending on the years you choose to participate, you may be eligible to utilize the higher 457 Special Catch-up limit when deferring your vacation and sick payout, allowing you to defer a larger portion of your payout. If you do not participate in the 457 Special Catch-up option, you may still be eligible for a higher contribution limit based on your age. All employees who will be age 50 or above by the end of the calendar year are subject to the increased age 50 plus catch-up limit. All employees who will turn ages 60 to 63 in the year are subject to the increased age 60 to 63 or super catch-up limit, which is even higher than the age 50 plus catch-up limit. You do not need to apply for these age-based limits. If you meet the age requirement, you will automatically be subject to the higher limit. Please note that you cannot utilize multiple catch-up options in one calendar year. If you are eligible for multiple catch-up options, then the option which provides the highest limit will be applied to your plan. If you would like to review these options in more detail, please schedule a meeting with one of Empower's retirement counselors. The counselor will help you better understand your options and complete the necessary forms. There are strict deadlines that must be met to take advantage of these opportunities, so please begin considering them right away. Another item to keep in mind is the IRS Required Minimum Distribution, or RMD. The IRS requires retirees to begin taking annual withdrawals from their defined contribution accounts upon reaching a certain age. Please review the IRS website for more information on when you will be required to begin withdrawing from your account. If you have any questions on the defined contribution plans, please contact Empower at 844-505-7283 or visit ctdcp.com.
Some of you are currently paying for additional benefits, like group life or home or auto insurance, through deductions from your paycheck. Once you retire, your group life benefit will reduce to a maximum of 50% of its current benefit, depending on your years of service. That reduced paid-up policy will be available to your beneficiaries for the remainder of your life at no cost to you. Additionally, you will be provided an opportunity to purchase the remainder of the value of your policy directly through the life insurance carrier. If you are currently having deductions from one of our supplemental benefits vendors, you should contact them directly to ensure a smooth transition of payments after your retirement. If you're not sure if you are participating in these benefits, please look at the after-tax deductions box at the bottom center of your pay stub. It is important to note payments for these benefits will not be deducted from your retirement check. You can find supplemental benefit details and vendor information on our CareCompass website at carecompass.ct.gov/supplemental benefits.
We will now be moving into the Q&A phase of our session. As a reminder, please utilize the raise hand function to join the queue to ask your questions, and please keep yourself muted until you've been called on. Thank you very much.